Are you always losing money in the markets? Well, if you're struggling with trading losses, the issue might not be a lack of information, but a misunderstanding of supply and demand. This is the secret institutions use to make millions in the markets. And that's why in today's video, I'll be breaking down supply and demand in 5 easy steps so you can be profitable and avoid losing money. But first, what is supply and demand? Imagine you're at a buzzing art auction. As more people show interest, price starts climbing. But as interest drops, price drops. And the final price reflects a simple story. How many people wanted the paintings? That's demand. Versus how many paintings were there? That's supply. When demand is high and supply is low, price goes up. When demand is low and supply is high, price goes down. And this isn't just an auction thing. It's how financial markets work. Whether it's stocks or forex, buyers and sellers are constantly competing with each other, just like at that auction. Now here's the kicker. In these markets, there are 2 main types of players: institutional traders, so big banks, hedge funds, and central banks, and retail traders, people like you and me. We retail traders make up a small portion of the overall trading activity. So it's the big players, like institutions, that actually move the markets. They're like the auction house experts. And think of the market as one continuous auction throughout the day, with buyers and sellers constantly competing with each other for the best possible price. Simply put, supply and demand zones are areas where smart money are trading at. And if you can identify these, you'll be trading alongside the big guys. But how do we actually apply this in our trading? It's simple. We buy at demand zones and sell at supply zones. And now that you understand the basics of supply and demand, I'm going to show you my 3-step process so you can identify these zones. And these principles can be applied to any time frame, whether it's the 1 minute, 4, or even weekly time frames. The first step is to identify the strong impulsive move. And in this example, we initially had this period of consolidation with these relatively smaller candles, then this huge impulsive move. So this long green candle with bullish momentum, indicating strong buying pressure, which pushed the market up. Now, many traders FOMO and buy, opening a long position to catch this breakout. But we don't want to do that. And this leads me to the second step, which is to identify the last candle before the impulsive move. Before this impulsive move up, we had this low volume, low momentum, red bearish candle. And we call this a demand zone in the case of an uptrend. And so we wait for price to return to here before entering, as this is likely where big money like institutions are entering. Now, in the vast majority of cases, a demand zone is a red candle. But what's more important than color is that it's the last candle before the impulsive move up. Now you might be wondering, why does price return to the demand zone or the last candle before the impulsive move? Well, after a strong impulsive move, there's not enough demand to keep pushing price further up. And so price returns to the area where institutional buyers previously stepped in, as these big players have a vested interest to ensure price does not drop below this zone to protect their initial open long positions, but also so they can buy even more at a discounted price. Similar principles applied to a downtrend, but instead of a demand zone, you call it a supply zone. And looking at this example, we had this strong impulsive move down shown by this long red candle. But the last candle before this impulsive move was this green candle. So this low momentum, low volume candle. And so this would be the supply zone in this scenario. Now the third step is to draw a box for the supply and demand zone. And in the case of this uptrend, we identified that it was this red candle that was the last candle before the impulsive move. And so we would mark this as the demand zone. Now this is where most people get confused. Personally, I draw it from the top wick to the bottom wick, and it doesn't really matter how big the candle is. In the case of the downtrend, we identified that it was this green candle that was the last candle before the impulsive move down. And so we would mark this as the supply zone. Again, drawing it from the top wick to the bottom wick. And once you've drawn the boxes, you can actually use these zones for trading opportunities. And in the case of the demand zone, you would wait for price to return like this, and then you can buy to take price much further up. In the case of the supply zone, you would wait for price to come back to it like this, and then you can sell to take price much lower down. Now that you know how to identify supply and demand, let's look at practical chart examples, because of course, real life is very different to textbook. And so looking at this 4-hour euro-dollar chart, you can see we had this strong impulsive move which took out the highs to the left here. And so the last candle before this impulsive move was this red candle. And so because this is the low volume, low momentum candle before the impulsive move, I would mark this as the demand zone. We would be looking to buy from here, as this is a discounted area where institutional buyers will likely step in to push price much further up. Now, shorting at supply zones in this case is riskier, especially as the prevailing trend is an uptrend. So let's see what happened next. So as you can see, price retraced to the demand zone and then pushed much further up. Let's look at another example using this 4-hour pound-dollar chart. And as you can see, we had this strong impulsive move down shown by this red bearish candle. Now, the last candle before this impulsive move down was this green candle. And so I would mark this as the supply zone, especially as it's the low volume, low momentum candle. Now, rather than FOMOing into a short position right here, it's better to wait for price to retrace to the supply zone and then sell. So let's see what happened next. So as you can see, price retraced to the supply zone, enabling us to sell and take price much lower down. Let's look at another example using this Australian dollar chart. As you can see, we had this massive sell-off which took out this major swing low here, and the strong impulsive move was this red bearish candle here, and the last candle before this impulsive move was this green candle. And so I would mark this green candle as the supply zone. So we can then wait for price to retrace to the supply zone before then selling. So let's see what happened next. So as you can see, price entered the supply zone, filling in our sell position, taking price much lower down. Remember, it's important to consider the market trend before entering trades at supply and demand zones to maximize your chances of winning. And not all zones are equal. And so here are 5 key tips to find higher probability zones. The first is the presence of a breakup structure. And this is the most simple and most effective filter. Only once the major swing structure gets taken out can we call it a valid demand or supply zone. Without a breaker structure, we do not have a valid zone. Next is unmitigated zones. Zones that have not been touched, or in other words, have a fair value gap or an imbalance, are more likely to be stronger. But in this example, the demand zone was mitigated, and because it was already touched, it was a low probability zone and price went straight past it. Thirdly, a liquidity sweep makes the zone higher probability, especially as institutions need to fill in their larger orders. And once liquidity has been swept, they're able to enter. And below lows, there is usually a cluster of retail traders stop losses. Fourth is high time frame confluence. Aligning your trades with the higher time frame market trend increases the likelihood of winning. For example, if you enter a long on a 4-hour demand zone and this overlaps with the daily demand zone, there's a higher probability of winning. Discount pricing can also give higher probability zones. After all, we want to buy low and sell high, and buying in the bottom 50% of the range, so discount, and selling in the top 50% of the range, so premium, can increase the chances of winning. So say you are in a massive daily downtrend, and then all of a sudden there's a structural shift when you zoom in on the 4-hour chart, going from a downtrend to an uptrend. This is in discount and so has a higher chance of winning. Whilst it's important to be aware of these 5 tips for finding higher probability supply and demand zones, the presence of all of them isn't essential for entering trades. Now that you understand supply and demand zones, how do you actually trade them? Well, here are 3 main methods. First is using limit orders. So set a limit order directly on the zone and wait for the entry to be triggered. Secondly is reversal candlesticks. So wait for a reversal green candlestick formation on the zone in the case of demand zones. Thirdly is waiting for lower time frame confirmation. So once price enters a zone and you see a low time frame breakup structure, then you can enter. There is no right or wrong for the exact method you use for entering trades. It just comes down to your preference and trading personality. And now that you've learned about supply and demand, you still need to learn about market structure to be a profitable trader. So check out my previous video to learn more about that.